Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. If you are new to the channel, please do not forget to subscribe to the channel and hit the like button on every video because that is a motivation for us. And guys, please do share videos with all your friends. As we can see that you people are not sharing as of now, right? Please do share because we are investing a lot of time here, right? And all of you must be having the books, and some of the students are saying that, sir, this book Economics of Finance, it's very good, right? And it will be very easy for you people to understand. And some of the students are saying that, sir, it's costly, sir. But if you people calculate the opportunity cost of the time that we are spending, the whole team is spending on providing these lectures free of cost on the YouTube, then you will realize what is the real cost of it, right? I could have easily provided this course for 5 to 6,000 rupees, which you are getting absolutely free of cost. So there is very a small investment that is required, and that is the what topic we are going to study in this lecture. That is the investment multiplier. This is the topic that we are going to study in this lecture now. This is investment multiplier, very important topic from examination point of view also, because many a times this topic has been asked in the examination of the EFF. Okay, guys, please do not take this subject lightly. This is an important part. 40 marks of FM EFF old course. This is very important, right? And this is one of the most scoring parts. You can easily score these marks because you will get the question for 2 marks, 3 marks or 5 marks numericals. So this is very easy. Okay, let's try to understand what is investment multiplier. Okay, I'll explain you with some simple examples that what does it mean. Let's try to understand. We studied about aggregate demand. What is aggregate demand? Aggregate demand is consumption expenditure plus investment expenditure. And there we discussed that this investment is constant in the short run, right? Because in the short run, on the routine, on the daily basis, we are not going about with the investment expenditure. Okay, we are going about with the consumption expenditure. Right, sir? This much is understood? Clear. Now he says this consumption function, this is a clear-cut function of income, which we have discussed that as the income increases, this consumption will increase. And on the diagram part also, we have studied about it that this is your income. This is your income and this is your aggregate demand, right? We say at zero level of income also, there will be some consumption expenditure. Now, further we say that this is your consumption line, right? This is your consumption line. This is C plus I. I is constant, and as the income increases, this consumption also increases, but it is a linear function, right? Now, if you want to increase this aggregate demand, how will this aggregate demand increase? So this will increase only if this investment expenditure will increase. Isn't it? This aggregate demand will increase only if there is this investment expenditure. This is again C plus I, and this difference is due to the increase in investment expenditure. Because consumption is a linear function of income. Income increases, consumption increases, but at the rate so that this is a linear function. Isn't it? The I remains constant. Now, if the investment increases, now this aggregate demand will increase. So let's try to read it now. We say we have already studied that aggregate demand is a sum total of consumption expenditure and the investment expenditure. Already discussed. Therefore, a change in the aggregate demand will take place only when there is a change in the C or I. Now he says aggregate demand will increase only if the consumption expenditure will increase or the investment expenditure will increase. But at the same time, he says, since C is a stable function of income, changes in the aggregate demand are mainly driven by the change in the level of investment. That is what I told you with this diagram, that aggregate demand, this increase in aggregate demand will be there only if the investment will increase, right? Because consumption is directly related to your income. As income increases, the consumption increases, right? This way the aggregate demand will increase, but the major shift This major shift in aggregate demand will come only when there is a huge investment expenditure. Investment expenditure will be in terms of amount, if we can say, it is whenever it is done, it is quite huge amount. Right now, what is this investment multiplier? What does it mean by investment multiplier? He says the investment multiplier refers to a phenomena where an increase in investment expenditure leads to proportionately higher increase in the level of national income. He says that if you are doing an investment expenditure, that will help in earning more income. Right, let's say you are investing in the machinery. Why you are investing in machinery? So that you are able to manufacture more goods, and manufacturing of more goods will lead to the increase in the national income. Isn't it very simple logic? Why a businessman is making an investment expenditure? He is making an investment expenditure because with that machinery that he is going to invest, right, with that machinery he is going to produce more quality products. With those quality products he can sell the goods at a very higher price, and which will lead to increase in the national income, obviously, right? So he says investment multiplier is increase in investment leads to proportionately higher increase in the national income. That means if you are making an investment of 100 rupees, your national income will be increasing by more than 100 rupees. That is known as investment multiplier. That means whatever the amount that you are investing 100 rupees, that grows many-fold. Leading to a higher increase in the national income. It is not like if you are investing 100 rupees, the national income will increase by 100 rupees only. You buy a machinery worth 100 rupees, you are manufacturing the goods and selling it worth 500 rupees, so your national income will increase by 500 rupees. Right, this is what is known as investment multiplier, that you are multiplying your investment many-fold. Clear? Let's take an example. If an investment increases by 100 rupees, the national income will increase by more than 100 rupees. Right? And what is that number by which it will increase? That is defined by the multiplier, which is defined by K. Right? K is the size of multiplier. What is the change? Right? Let's say if my investment, I say my investment increases by 100 rupees and my income increases by 500. Right? That is 5 times the investment. This 5 times is your K. Right? This is your K, this is your investment. That this is 5 times the investment growth. So delta Y by delta I, that is the change in the income due to the change in investment. Right? This is how we read this ratio, that change in income due to change in investment. Right? So Y is the change in the national income and delta I is the change in investment. Now let's see how this investment multiplier works with the help of an example. Let's see with the help of an example. XYZ Limited wants to build a warehouse. That is, it is an investment expenditure for rupees 10 lakh. Right? For this, let us say there is an expense of 5 lakhs on the labor, factors of production, and the 5 lakh on material. Now they want an investment expenditure of 10 lakh rupees. For that, 5 lakh is labor and 5 lakh is material. We are not taking overheads, right? Don't confuse it with the costing part. This is just an example that we are taking. Now what happens? This becomes the income of the factors of production. This becomes the income of factors of production, and this 5 lakh becomes the income of material supplier, isn't it? Now this will lead to an increase in the income of labor and material supplier by 5 lakh. Now let us say MPC is 80%. MPC is marginal propensity to consume. That is, this factor of production is earning 5 lakh rupees, and this out of this 5 lakh, 80% he will be spending on consumption and 20% he will save. That is what is MPC. MPC says whatever you are earning, 80% you will be spending on the consumption expenditure and 20% you will be saving. Then the labor and the material supplier will spend 80% of their income, that is 4 lakh rupees they will spend as consumption expenditure. Now, whenever they are spending 4 lakh rupees as consumption expenditure, it will become income for someone else, isn't it? It will become income for someone else. thereby leading to an increase in the income of some other person, and the process goes on like this. Now, some other people who are getting 4 lakh rupees, they will be having some MPC, right? When they will be spending on consumption expenditure, that will become the income of another person. This process will keep on repeating. Sir, then this will be a never ending process. No, it is not like that. It is not like that. This process will end. This process is not a never ending process. Why? Why it is not a never ending process? Because of the presence of leakages. What are leakages? We will discuss about that, right? So one thing is clear from the above example, that income will increase only when there is a consumption expenditure. This thing we are able to understand from this example, that if you are going to do the expenditure, if you will spend money, only then it will be income for someone else, right? If you are going to keep that money in your pocket and you are not spending the money, will that be income for someone else? No, sir, that will not be income for someone else, isn't it? So he says there is a direct relationship. There is a direct relationship between investment multiplier and MPC. That, sir, if you want to your investment to multiply, there must be a consumption expenditure. If there is a consumption expenditure, only then your investment will multiply. That means there is a direct relationship between what? Investment multiplier and MPC. Now, and on the same hand, there is an inverse relationship between investment multiplier and MPS, that if you will keep on saving more and less of consumption expenditure, then what will happen? Your investment multiplier will not increase by the way it should be, right? Because if the people will save more, consumption expenditure will be less, thereby not leading to increase in income. If you keep on saving, how will the income increase? No, sir, it is not going to increase. Clear? So delta y by delta I is equal to inverse relationship, that is 1 divided by MPS. This shows the inverse relationship. Inverse relationship, right? This is the inverse relationship, and MPS can be written as 1 minus MPC. This shows the direct relationship with MPC. This shows the direct relationship with MPC. Clear? This is inverse relationship with MPS. Clear? So this much is clear, that what is investment multiplier, that whatever the amount that you are investing, it is going to grow multifold, but it will grow only if there is a consumption expenditure. If you are going to save money, if you are going to keep on saving the money, in that case your money is not going to grow. Clear? Right. Now he says, in the underdeveloped countries, the MPC is high, but the value of investment multiplier is low due to the structural inadequacies. Now, in the underdeveloped countries, what is happening? Obviously, the consumption expenditure is very high, right? But at the same time, the investment multiplier is low. Why? Because there is less investment in the multiplier. There is less investment sector, right? Due to the structural inadequacies. Now, if you say that you want to build a huge stadium in the underdeveloped country, that country might not be having that funds to build that stadium, right? Because the consumption expenditure is obviously high, because the people there, they are not spending on investment, they are spending on the consumer goods. That is an underdeveloped country. People say that we need to live we should be spending on the basics rather than on investing the huge amounts, right? So what they are concerned with is the consumption on the basics. That is why we say the MPC is high, but the investment multiplier is still low, right? In such cases, the increase in the consumption expenditure is generally accompanied by increase in production. Obviously, if there is an increase in the consumption expenditure, you will need to produce more, right? So he says here the investment multiplier is low, that the money is not growing at that rate, right? As it should be according to the MPC. There, although it will grow, but whatever the consumption expenditure is, the high consumption expenditure is accompanied by increase in production. However, now this point, important point here. One second. Now this is an important point here. He says However, this process of income multiplication does not continue forever. That is what I told you, that the income multiplication will not go on forever. It gradually slows down and comes to a halt. This happens due to leakages in the economy. Now, what are leakages? Let's try to understand. What are leakages? Come to page 2.15. What are leakages and what are injections? Right? Injections. Okay, the leakages refer to the withdrawal of money from the circular flow. Now, what does it mean? Let's try to understand with the help of an example. Let's say there is a household, right? And there is a firm. There is a firm. Right, sir. Now the household provided the factor services, right? And the firm paid this household rupees 10,000 as factor income. As factor income. Now this household is going to spend this 10,000. The household, what is doing is this household is spending on consumption expenditure, and here he's saving also. He's spending 8,000 rupees and he's saving 2,000 rupees. Right now, this 8,000 rupees will again go to the firms in the form of consumption expenditure. Right? Obviously, the households will buy the goods and services worth 8,000 now. 8,000. Initially, they received 10,000. Now, this 2,000 rupees which they have saved, this is not going into the circular flow now. Right? It is still there with the household. Is it going into the circular flow? No, sir. So, this is what is known as leakages. Right? Another example, let's take another example. This is the savings example, sir. Is this the only leakage? No, sir. There can be another leakages. If you talk about the two sector model, this is the leakage. The savings is the leakage if they are going for the savings. Now we will be doing the three sector model also. There, what will happen, sir? Here is the household, right? And here are the firms. Now, households are providing the factor services. The firms are providing the factors income, let's say 10,000 rupees. Now, the household has 10,000 rupees in his pocket, right? What is happening? He is for consumption, and also this household, he's spending 8,000 on the consumption, right? And he's saving 1,000 rupees. Let's say he's saving 1,000 rupees. Sir, what about the remaining 1,000? This remaining 1,000 is the taxes that he's paying on his income. Obviously, right? This is the three sector model we will discuss after this investment multiplier. So he will be paying the taxes. Now, in this case, what happens? Now, what is the money available? Sir, this 8,000 in the circular flow, this 8,000 will flow. What about this 1,000 and the 1,000? What about this part? Savings and taxes. Sorry. What about the savings and taxes? Sir, these are the leakages from the economy. This is known as leakages, that the money which is not going into the circular flow again, right? That is a leakages from the economy, right? That is what is given here. When the household and the firms save a part of their income, it leads to a leakage from the circular flow of income. As a result, it is not available for spending on currently produced goods and services. Leakages reduce the flow of income. Obviously, it will keep on reducing. Example, savings in a two-sector model, savings and taxes in a three-sector model, saving, taxes and imports in a four-sector model. This we will discuss on. In the two-sector model, how the savings are there, I have just explained you that they are going to save 2,000 rupees. That is why this 2,000 rupees is not going into the circular flow now, right? Only 8,000 rupees will be available for consumption expenditure. Only 8,000 will be done, right, in the buying of goods and services. So it will be the circular flow. 2,000 will be in my pocket only. Clear? So this is how the leakages work. Injections we will do later on. What I wanted is leakages, that you people are able to understand what are the leakages. That is what is there. Progressive taxation, that is higher the income, higher the taxes. Now you will pay the taxes, you will have less of income, the remaining income which will go into the circular flow. High liquidity preference and idle savings, that is you want that more and more should be saved. More and more money should be saved. That is why increased demand satisfied through the existing stock or import, that you are satisfied, you don't want to do any other consumption expenditure, right? You say, let's save money, whatever I have, I am literally satisfied with that. I don't need anything else, so no further consumption expenditure, right? Undistributed profits of the companies. Now the corporates, they earn the profit, they retain the money for further investment, they are not distributing that money. If that money is not distributed, how the consumption expenditure will take place? That is not possible, isn't it? So additional income used for the payment of debts. Now you have taken money from someone, you are returning that money, right? So if you have taken 1000 rupees for someone, you will be repaying that 1000 rupees. So that 1000 is not available with you now. You earned 10,000 rupees. Out of that 1000, you have repaid your debt. Now, what is the available money? Only 9,000 rupees, which will go into the consumption expenditure, right? Situation of full employment leading to inflation, increase in the prices, scarcity of goods and services despite having the high MPC. This is normally in the underdeveloped countries, okay? So in the diagram below, with a small increase in the investment, there is a significant change in the income from Y0 to Y1. Let's see the example, sir. Let's see the example. That is what I have explained earlier also, that this is the aggregate demand that we are taking, right? And on the x-axis, we have the income. This is income, right? So this income, this is the total income, that is consumption plus the savings, okay? Now this is A, that is the minimum expenditure at the zero level of income, where you will have the dis savings. Isn't it? This we have already discussed. Now this is C plus I when the I is constant. That is, as you keep on increasing the income, your consumption expenditure will increase. But it will be a linear function. But how to increase the major change in the aggregate demand, the shift in this line, only when there is a change in the investment expenditure. Now what happened, sir? This is the total income. Earlier, this was the equilibrium level, right? This was the equilibrium level. Now, as you increased the consumption expenditure, your income, this was the Y0 income at equilibrium level. Now, what is the income, sir? As you increased this investment expenditure, your income increased from Y0 to Y1. See, the change here is bigger. This is a small change, that is delta I. This is a bigger change, that is delta Y, right? This is what is investment multiplier, that with a small change in the investment, that your income will grow multifold, right? There will be a higher change in the income. So this is what is explained by this diagram. Clear? So this is a very important part, investment multiplier, guys. From the examination point of view also, as I told you, this is very, very important. Okay, now we are going to do some practical questions on it, numerical illustrations from your module itself. Illustration number 9. He says, in an economy, the investment expenditure is increased by 400 rupees. That is, this is your delta I. And the marginal propensity to consume is 0.8. What is the marginal propensity to consume? That is 0.8. Calculate the total increase in income, that is delta Y, and the savings, that is delta. What is the savings here? Total increase in income and savings, right? So savings will be delta S, right? Change in the savings. This is how you need to calculate. Now we have discussed that how this multiplier is calculated. What is the multiplier, sir? Multiplier has a direct relation with MPC, that is 1 divided by 1 minus MPC. Any doubts in this thing? Now he says MPC is 0.8, delta is 400 crore. What is multiplier? Multiplier is 1 divided by 1 minus MPC. That is what we have studied here. 1 divided by 1 minus MPC, is it equal to K, right? So the value of MPC is available from here. We can calculate the value of K, that comes out to 5. Now what is K? The K is also written as delta change in the Y due to change in investment, right? Change in Y, and now you want to calculate this part. K is 5, investment is given as 400. So delta Y will be what? 2000 crores. That if you invest 400 crores, your income, the national income will increase by 2000 crores. Clear? Any doubts in this thing? Now he says you need to calculate the increase in the savings also, delta Y. What is delta Y? Sir, we have discussed about MPS. What is MPS? Sir, change in the savings due to change in income. What is MPS here? Sir, if MPC is 0.8, what is your MPS? MPS is 0.2. So 0.2 is equal to delta S divided by delta Y is 2000. Right? So from here, you need to calculate, from here you can easily calculate the value of delta S. Delta S is equal to 0.2 multiplied by 2000, that is 400 crores. Clear? So what we are doing is, we are applying everything that we have studied so far. MPS, MPC, investment multiplier. Let's move to illustration number 10. An increase in the investment by 400 crore leads to an increase in the national income by 1600 crores. Calculate the marginal propensity to consume. How it can be calculated? He says delta I is 400, right? Delta Y is 1600. So you can calculate the value of K here. You can calculate the value of K here, that is the change in income due to change in investment. That is 1600 divided by 400, the K comes out to 4. Now, on the other hand, we say that the value of K is equal to 1 divided by 1 minus MPC. K is 4. So 4 is equal to 1 divided by 1 minus MPC. Right? I can write it as what? 4 minus 4 MPC is equal to 1. Right? So from here we can say 4 MPC is equal to 3. So MPC is equal to 3 by 4. Let's see, 0.75. Right? 3 by 4 is 0.75. Clear? Any doubts in this thing? So what we are doing is, we are using all the interrelationships whatever we can, that K is equal to delta Y by delta I is equal to 1 divided by 1 minus MPC is equal to 1 divided by MPS. So we are using all these relations. Let's move on to illustration number 11. Let's see what the illustration number 11 has to say. It is almost similar to illustration number 9, 10. These are almost similar illustrations. In an economy, the investment is increased by 600 crores. This is delta I. If the marginal propensity to consume is 0.6, calculate the total increase in income and consumption expenditure. Now, this is similar to illustration number 9, but what he is saying is, here instead of the savings, he is asking you to calculate delta C. Very simple. Instead of MPS, you will be using MPC. That's it. The MPC is already given to you. What you have to calculate first is the change in the income. So MPC is 0.6, delta is 600 crore. You can easily calculate the multiplier. That is 1 divided by 1 minus MPC. The multiplier comes out to 25. Now you have the value of K, you have the value of delta I. You can easily calculate delta Y here. That comes to 1500 crores. Now what is MPC? What is MPC? MPC is change in consumption expenditure due to change in income. This is what we studied. Now MPC is given as 0.6 multiplied by what is delta Y, that is 1500 crores, is equal to change in consumption expenditure, that comes to 900 crores. Clear? Simple. Let's move on to the last illustration of this part, illustration number 12. Suppose in a country the investment increases by 100 crores, that is delta I, and the consumption is given by C is equal to 10 plus 0.6 Y, where C is equal to consumption and Y is equal to income. How much increase will take place in the income? Now sir, in this question you have to identify how to do it. Sir, delta Y you need to calculate. Right? Increase in income is delta Y you need to calculate. Now what is, when we talk about C is equal to A plus BY, this is the way it is given, 10 plus 0.6Y. Now what is this B? Can you tell me? We have studied about what is this B? Sir, this B is nothing but your MPC. Isn't it? That means here this 0.6 is your MPC. Now you can calculate. Now you will calculate the value of K, that is 1 divided by 1 minus MPC. MPC is 0.6, that is 2.5. Now you have the value of K and you have the value of delta I. You can easily calculate the value of delta Y, that comes to 250 crores. That by investing 100 crores, your income will increase by 250 crores, right? So this was all about the investment multiplier, and as I told you, this is a very, very important topic. Now in the next lecture, we will be continuing. This two sector model is complete. In the next part, we will be discussing about the three sector model, right? Very interesting, I tell you. This three sector model is going to be very, very interesting. Then four sector model and the end of the chapter. Right, we are very near to the end of this chapter with the three sector model, and after that with the four sector model we are going to complete this chapter, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.